A very good evening to all of you. This is the fourth session of our Shastrartha series that we are hosting today. And it is a very exciting as well as the topic of the hour, default guarantees, structured default guarantees that we'll be discussing today. Structured default guarantees were actually born out of the need to mitigate credit risk in lending practices. Lenders sought a mechanism to protect themselves from the financial consequence of borrower defaults, and this prompted the emergence of guarantee arrangements. FLDG, as it was popularly known as, transferred the risk of default to a guarantee provider. Usually these were sourcing agents who would provide an added layer of security to the lender. Now, by providing or offering this kind of a safety net against the borrower defaults, FLTG encouraged not only new players in the industry, but also traditional lenders to venture into the new lending market, including digital lending. And inadvertently, these arrangements were actually encouraging a sort of a regulatory arbitrage, because lenders could leverage the guarantee to circumvent the existing regulations. So it was increasing the systemic risk that is being faced by the lenders. Now, given the guarantee providers were usually unregulated entities, they also did not possess the necessary expertise, the financial capacity to absorb the losses. The due diligence was not properly done. There was weak governance. All of this led to increase in this systemic risk. Now, the regulator has tried to strike a balance between risk mitigation and innovation. And that is the reason why there has been a framework that has been introduced, a regulatory framework for default loss guarantees, to not only ensure regulatory compliance, but also consider the innovation that could be possible in the financial sector. These regulations have been brought in by the RBI after consultation with the stakeholders, and the default loss guarantee guidelines lay down with the process. You can say what would be the quantum of guarantee, what could be the form of guarantee, who could be the guarantee provider, and all such other nuances relating to default loss guarantees. So there would be a lot of questions in our minds with respect to the new guidelines. And now let us seek those answers from the expert himself, Mr. Kothari, Mr. Vinod Kothari, who is here with us. So why are these guidelines restricted only to digital loans and not non-digital loans? Because we see that the guidelines have been referred to as default structured default guarantees for digital loans. So what are your views in case of guarantees that are extended for non-digital loans?
Anita, I think while you were doing the introduction, you made a point there saying that the availability of guarantees opened up new avenues for lenders to foray into digital lending. Now, that's a very important point because digital lending is something which requires technical expertise, it requires technical resources, it requires technology platforms. And I think it would be counterintuitive to think of traditional lenders to build up capabilities of digital lending themselves. So as is the reality, digital lending originators are entities which are technologically strong. They don't have balance sheets to create loans on the balance sheet. Even if they are regulated entities to a certain extent, they have limited lending strength on the balance sheet. At the same time, for the traditional balance sheet lenders, they have resources, they have liabilities, they have funds, but obviously they would not have technical competence to start originating digital loans. So this alliance between a traditional lender and a new age technology platform, that is so-called digital originators, that was obviously necessitating some kind of a backup support from the lenders. I mean, from the originators, sourcing partners. Because in absence of any support from the sourcing partner, the lender is taking quite an open call on who the borrower is. Now, basically, the borrowers are getting evaluated by the platforms themselves. Platforms contend that they have some kind of expertise in doing a non-traditional evaluation of the borrower. They're rummaging through a whole lot of data, including social or whatever, so psychometric data of the borrower, trying to assess the borrower's capabilities. Now, somebody who contends that I have evaluated, let's say Vinod Kothari, and found him to be a good borrower for a loan of 1 lakh. Merely me saying that Vinod Kothari is good for 1 lakh, and then I take this loan to, let's say, traditional lender, say State Bank of India. But I don't have any skin in the game in this referral, so to say. It becomes difficult for a State Bank of India to, because State Bank of India obviously will not have the same, what you call, proprietary platform or proprietary technology to do the same evaluation. And therefore, for the one who is doing sourcing to be able to say that I have a skin in the game, I have exposure in this transaction, I'm exposing some bit of my money as well, and I stand ready to provide a credit support up to a limited level. Therefore, in case of digital lending, there was a need for some kind of guarantee support. Now, that need obviously cannot be extended to non-digital loans. Non-digital loans is something which lenders have been doing over the years. Lenders are expected to have their own capabilities for sourcing or originating non-digital loans. And therefore, in case of non-digital loans, there is no equivalent framework for default loss guarantees. And in fact, the RBI's general prohibition on what is called synthetic securitization continues to apply there, which means if there is a synthetic shifting of risk and rewards without shifting the loans. Now, risk and rewards and the loan should normally go hand in hand, which means if I want to transfer the risk and reward of the loan, I should actually transfer the loan itself following the so-called transfer of loan exposure framework. But if I'm shifting the risk and rewards without shifting the loan, then that's what the RBI terms as synthetic. Synthetic meaning not actual transfer of risk and not actual transfer of the loan, but merely economically shifting the risk and rewards without shifting the loan. That's the coin is called synthetic securitization. It's not RBI's innovation. Synthetic securitizations have been there for almost like, I would say, since 97, they've been there globally. And therefore, it has had a history of 26 good years. It went through periods of bust during the global financial crisis, is regaining prominence elsewhere in the world. However, in our country, we continue to see synthetic securitization with some degree of suspicion. Therefore, we have not permitted that. And therefore, the bar on synthetic securitization, which the RBI has imposed via the digital lending guidelines, when I would say that bar is not a part of digital lending guidelines as such, that's a part of the securitization framework itself. And therefore, that bar extends to non-digital loans. Therefore, in case of non-digital lending, the question of giving a default loss guarantee does not apply. Whereas in case of digital lending guidelines, sorry, digital lending transactions, a limited structured default guarantee may be extended. That's the reason why it's been extended in case of digital loans only.
So if I have to say it in a way, in case I'm doing digital lending transactions, I will open these guidelines and see if there is any guarantee structure or a guarantee arrangement that has to be in compliance with these guidelines. However, in case of non-digital loans, synthetic securitization or structured guarantee kind of arrangements will be prohibited or cannot be done.
I mean, a pool-based guarantee, a structured guarantee, a pool-based guarantee, and normally a guarantee coupled with shifting of rewards as well. I mean, I would call it synthetic securitization as a combination of several elements, not merely shifting of risk, but shifting of risk and rewards. And this is normally a what you call multi-tranche or structured transaction where a layer of risk and rewards goes away, a layer of risk and normally a upper what you call cream of rewards, a sort of top up of rewards that also gets shifted. So synthetic securitization prohibition will continue to apply in case of non-digital loans. In case of digital lending, a limited leeway, a limited carve out has been given by the 8th June guidelines. Anita.
So this would be the difference between digital loan and non-digital loan. Now we also have certain structures that are commonly being practiced, which is co-lending transactions. Will the guidelines apply in case of a co-lending transaction? Why I'm asking this question, because under a co-lending transaction, one of the co-lenders is actually acting as the sourcing agent and carrying out several servicing functions on behalf of both the co-lenders. So in that case, can I say that the co-lender, the one who is sourcing the borrowers for me or carrying out the servicing function, is an LSP? And in that case, can I say that the guidelines will be applicable? Can I take a guarantee from the co-lender? What are your views on this?
So Anita, first of all, I must say that this question and therefore the answer to the question is extremely significant and is quite a sensitive question given the fact that whole lot of these digital lending arrangements are now structured as co-lending transactions. There are various motivations for people structuring the arrangements as co-lending rather than pure loan sourcing arrangements, or so-called business solid word. I mean, sourcing arrangements plainly, but they've mostly been structured these days as co-lending arrangements. In case of a co-lending transaction, the two lenders are coming together to extend a loan. And looking at the language of the DLG guidelines of 8th June, it appears that the eligibility of a guarantor depends on the guarantor being a loan sourcing partner. The guarantor has to be LSP. The guarantor may be an RE, regulated entity. Guarantor may not be an RE, but nevertheless, the guarantor is a loan sourcing partner. And that is very easy to understand because the one who is sourcing is putting a weight of his own exposure by saying that I have sourced and I'm also exposed to a certain extent for the loans that I've sourced. I've sourced it for you. I am not the lender myself. I'm simply an LSP. I might be a regulated entity, but I'm not exposed myself on the loan itself. And therefore, because I'm not exposed, I'm giving it to you. Hence, I'm indicating a skin in the game saying I have a certain responsibility by way of a guarantee. So this presupposes a separation or segregation between the LSP and the lender. LSP giving a guarantee to a lender, lender getting the benefit of a guarantee from someone who's not a lender himself. A co-lending transaction, on the other hand, is coming together of two lenders. Both the lenders are lenders. And I cannot say that the co-lender is acting as a loan sourcing partner for the other co-lender. While we do understand that in all co-lending arrangements, the arrangement, the splitting of responsibilities would be such that one is doing sourcing, one is doing customer interface, one is doing KYC, one is therefore effectively doing the entire origination and servicing, other one is entering only as a funding partner. But that contention still cannot lead us to conclude that one co-lender is an agent for the other co-lender. The two co-lenders are acting together as lenders and they are lending to a borrower. So while I'll be very happy if the RBI comes up with different view, and therefore the market will be greatly benefited because co-lending seems to be the in thing. But our current reading of the DLG guidelines seems to suggest that it's only in case of an LSP that guarantee can be given, and co-lender cannot be said to be an LSP for the other co-lender. Anita.
So I think you have covered the eligibility for the DLG provider, which means has to be an LSP, or even if it is a regulated entity, it must have entered into any outsourcing or LSP arrangement with the lender to be able to provide this kind of a default loss guarantee.
I would just pause you for a second, Anita, to further say that LSP can be providing various services. In fact, even a person who's providing collection services is also an LSP. LSP can be somebody who's simply, let's say, doing credit evaluation is also an LSP. But here, logically, the LSP is the one who's doing sourcing of the loans, because the one who's sourcing intuitively goes and says to the lender that I'm the one sourcing and referring the loan to you, and I'm also backing it up with my guarantee. So when we say LSP, we are actually meaning to say the loan sourcing partner, not simply the lending services. Lending services can be diverse, as you understand.
So a follow-up question on that, just to clarify, you are saying that in case, because LSP as a definition would mean anyone who is providing any one of the lender functions. So if as an LSP, I'm providing any of the other lender functions, be it credit evaluation or servicing, collection, recovery, can those agents provide this default guarantee? Or
to my mind, that would be counterintuitive, because the idea basically is the one who's sourcing and referring the loan to the lender for the lender to expose himself is the one who says, well, I am the one who's sourcing and I stand by the quality of the loan by extending my guarantee. But technically, one can keep on, I mean, even a collection agent, for example, is LSP, but I don't think it would be proper to, it would be defeating economic argument of a guarantee. Why would somebody who is not at all involved in sourcing of the loan extend his guarantee?
right. Now, this guarantee arrangement, as per the guidelines, there's also a limit that has been placed on the extent of the guarantee, which is 5%. Now, how do we work out this 5% limit? Will it be on the disbursement? Will it be on the POS? And how will the same be monitored on a portfolio basis, the limit of guarantee?
Right. So that's a practically extremely significant question. And when you work it out in practice, you are surely going to encounter a whole lot of mathematical challenges, because this is exactly the so-called static loan cash flow modeling exercise. Conceptually, what we're trying to say is that if I've given a loan of rupees 100 and therefore I've sought a guarantee of rupees 5. Now that 5 rupees is the guarantee provided by the guarantor. The 100 rupees loan will continue to amortize over time. Most of the loans are amortizing. They're not sort of bullet repaying loans. The loans are amortizing over time. So question, supposing there was only one loan of 100 rupees and there was a guarantee of 5 rupees against it. The 100 rupees keeps on amortizing. After a time, let's say 100 becomes 50, 50 becomes 30, 30 becomes 20, 20 becomes 10. Will the guarantee still remain 5? The answer is still yes. The guarantee will remain 5 till the loan drops to a value of 5. Once the loan drops to a value of, let's say, 4, then the guarantee will stand reduced to 4, because there's no question of guaranteeing more than the outstanding value of the loan. So if we understand the working of the default loss guarantee, in case of a single loan, it wouldn't be difficult to extend it to a portfolio of loans, because most of the guarantees actually are on a portfolio basis. It's up to you as to how you define the portfolio. You can define the portfolio to mean all originations during a month. You can define the portfolio to mean all originations during several months. You can define it to mean originations up to a particular, origination level. For example, say, no matter how many months it takes, but let's say with ramp up of loans up to rupees 100 crores. That might be my definition of a pool. Or to make it even more complicated, it might be a guarantee pertaining to a revolving pool. That is not a static pool, but a revolving pool, such that as loans originated in a particular month continue to amortize, we continue to add further loans in that very pool itself. So to keep the matter simple, let's first think in terms of a static pool. In case of a static pool, the guarantee is based on the disbursal made by the lender on the strength of the guarantee. Like I took the example of 100 rupees. If I, let's say, instead of 100, I talk about 100 rupees ke various loans, let's say, extended during a month, then the 5% will be the total disbursements made in respect of a cohort or as a pool, let's say loans originated in a particular month. If I define the pool to mean, let's say, originations up to rupees 100 crores until I reach 100 crores of or disbursements. I'm not talking about post value. I'm talking about disbursement. Please understand, it's not 5% of outstanding POS, because POS continues to amortize. We're talking about the total disbursement value till we reach a pool size of, say, rupees 100 crores. it would be 5% of that disbursement. In case of revolving pools, as the pool value amortizes, you continue to add further loans. So there also we'll talk about the cumulative value of disbursements. Therefore, this 5% will always be 5% of the disbursements made in terms of the guarantee arrangement. That's my understanding. I hope it was clear, was it?
Yes. So what we understood is that this 5% capping, first of all, it will be on the disbursement level, and whether it is the cohort basis over a period, or the cohort dependent the quantum of the loans that we are originating under the arrangement, that needs to be specified, based on which we will be determining the limit.
So that's a contractual part. I mean, the parties can contract so as to relate the 5% to originations during a month, or originations till we reach a cumulative disbursement of a particular amount. But in case of revolving support, it would be based on the cumulative disbursements. Disbursements, that's the key word, is disbursement, not the outstanding pause.
Right. So if this DLG that is being provided on disbursements, now when I'm talking about utilization of this guarantee, could it be structured as a first loss or a second loss as well? Should it be only a first loss support that I provide, or could it also be structured as a second loss support?
Now, structured default guarantees, first of all, I must say that what is intended to be covered by the DLG guidelines is a structured default guarantee. For example, a 100% default guarantee is not a structured default guarantee. That's not something which is intended to be covered by the guidelines, because that's equivalent to guaranteeing each loan originated by a lender. That's loan by loan guarantee and not a pool-based guarantee. Pool-based guarantees make sense only when it's relating to a particular slice, a particular tranche of the pool. Now, the slicing can relate to either the first loss tranche, may relate to a second loss tranche. My first, second is basically just a number. I could probably say the horizontal or the base level tranche, and then could probably have mezzanine tranche and then senior tranches. I can probably also give or take a guarantee for a super senior tranche as well. So it's possible to structure a guarantee for any layer, first loss, second loss, third loss, or whatever loss. But intuitive idea of seeking a guarantee is that defaults up to a particular level will be met by the guarantor. When the losses spill over the guaranteed level, then they'll travel back to me, and that is travel back to the lender. So in the intuitive idea of a structured default guarantee is to make the sourcing partner exposed to a first layer of losses up to a certain default amount. But that doesn't stop the parties from contracting such that first loss, let's say up to 2 or 3%, the lender takes himself, and the losses beyond the first loss level are those which are guaranteed by the lender. So it's perfectly a workable proposition to think in terms of a second loss guarantee instead of a first loss guarantee. Like I mentioned, first or second is merely a number. But the moment we say first or second loss, we are sort of supposing that the first loss support in that case, the first loss number is itself thick enough to make the second loss a senior tranche. Mane, supposing I say 0.1% loss I'll take to myself and all remaining losses go to you, then that, while technically I say it's, well, there is a there's, for example, 0.1% first loss tranche, and therefore the next layer becomes a second loss, but that is not the intent of first or second loss tranches. Normally, if you're calling something second loss, we are saying the thickness of the first loss tranche is sufficient to at least absorb the expected losses of the transaction. But it's quite possible, I would repeat once again, quite possible to structure a second loss guarantee as well, in which case again the cap of 5% will apply.
Now, going back to the eligibility of the guarantor, you mentioned that it will be counterintuitive to say anyone else apart from the sourcing agent is actually providing this guarantee. But is there a possibility that I can avail the guarantee from multiple LSP instead of just one, just the sourcing agent? Can I have multiple LSPs who are providing this kind of a guarantee? And if yes, whether this threshold of 5%, will it be considered separately for each LSP, or will it be a cumulative limit?
So I think I'm going back to my answer which I gave earlier, that I'm not envisaging the guarantee to be divorced from the sourcing function. The one who is sourcing the loans is the one who's guaranteeing. And that's the economic argument of the sourcing partner putting his own exposure on the loans that are sourced through him. Now, I can't obviously think in terms of more than one sourcing agent for a loan. And therefore, the question of more than one guarantee, to my mind, is not germane to a sourcing proposition. However, if for whatever reason you have more than one guarantor, I think the overall limit of 5% would still remain for all the guarantees put together. Though I'm once again saying that these are, I think, technically stretching the concept of guarantee, but it should actually be guarantee from the one who is actually sourcing the loans. Anita.
So now the guidelines have also introduced this new concept of implicit guarantee. They talk about having an implicit guarantee is possible, and that also has to comply with the regulatory framework. What do you mean by implicit guarantee would be my first question.
So something which is not technically structured as a guarantee, but is serving the economic function of a guarantee. What's a guarantee? A guarantee is when a lender is compensated by the guarantor for the deficit in the loan or defaulted amount in the loan suffered by him. So economically, if the same function of absorbing the defaults is being performed by someone who is not technically a guarantor, but is using his whatever resources to make good those defaults. Let's say by setting a kind of reservoir, or let's say by setting whatever economic arrangement which is not technically a guarantee. So something which is explicitly not a guarantee, but is serving the economic function of a guarantee. That's what we will call economic or implicit guarantee. We are not saying it's an informal arrangement, because RBI cannot be thinking in terms of people informally agreeing to compensate. It's a formal arrangement, but a formal arrangement which is not technically a guarantee, but still serves the economic purpose of enabling the lender to compensate himself for the losses by pulling money from the so-called implicit guarantee provider, in whichever form he pulls the money from.
If I may ask you to provide an example of this kind of an implicit guarantee structure.
So let's say the LSP has created some kind of a reservoir. And the reservoir can be, let's say, built by whatever means. And as and when defaults occur, or for instance, think of, let's say, the lending service provider, say, agrees to give a loan to the borrower for the borrower to repay to the lender. So implicitly, all I'm doing is I'm stepping in to compensate the lender for his defaults. And therefore, I'm economically creating the same scenario that would have been there in case of a guarantee. So because you're talking about something which is substantively a guarantee, substantive guarantees cannot really have, limited illustration. There can be various arrangements which might lead to a so-called implicit guarantee, but whatever be the format of such implicit support, if the support is against defaults and the support comes up when there's a default, the support comes up making the so-called support provider committed to absorb losses of the lender. That's where we will say it's a case of implicit guarantee.
So in case the LSP acting as a service provider agrees for a fee-based or a matrix of fee based on the collection efficiency, will this also be treated as a implicit guarantee?
In my view, not. Because differential servicing fees, I'm paid servicing fees which are based on collection efficiency. If the collection efficiency is, say, below 90%, I get nothing at all. I'll just get a bare minimal, for example, a fixed servicing fee, which is, let's say, a small fee, a fixed fee. And then as the collection efficiency improves, I get higher and higher servicing fees. So I am rewarded for higher collection efficiency. I'm not guaranteeing. Am I saying that if the collections drop, let's say, below 90, I'll make good the default? I'm not saying that. So guarantee is when the so-called guarantee provider, whether technically a guarantee or not, steps in to take the loss upon himself. I'm not saying I'm taking loss upon himself. All I'm saying is that my fees themselves are structured with a multi-tranche, with a matrix of servicing fees. My servicing fees continue to increase as the portfolio performs better and better. And therefore, again, we are also not saying that the entire excess spread over a particular rate of return is swept by the so-called servicing provider here. The lender also shares. Lender also takes a share in the upside, but the lender's share in the upside continues to reduce, and the servicing partner's share in the upside continues to increase as the collection efficiency goes up. This kind of a matrix-based sharing of servicing fees, in my understanding, is not a case of guarantee, because guarantee, the essential element of a guarantee is guarantor agrees to compensate, which means guarantor agrees to take the loss on himself. Here, the so-called servicing provider is not agreeing to take the loss on himself. He's saying, I will take lesser servicing fees. Therefore, I'll sacrifice part of my servicing fees. I'll be entitled to a fixed service fee, but the remaining excess service fee is linked with the performance of the portfolio. That, to my mind, is not a case of guarantee, either explicit or implicit.
So now that we know who can provide the guarantee, what will be the limit of the guarantee, how it can be structured, what are the components of implicit guarantee, moving on to the invocation part. Now, what is the meaning of default? When can the guarantee be triggered? If the guarantee is triggered, what money does the lender recover? Is it only the EMI which are in default, or the entire loan amount can be recovered as a part of the guarantee arrangement? Because the guidelines seem to suggest that the loan will not be subrogated to the guarantor, and it permits contractual arrangement for sharing the subsequent recoveries, if there are any. So what should be the treatment for these recovery? First on the default part and then on the recovery part.
So I think let's split the question into several sub-questions. First question is, what is the meaning of default? Do the guidelines kind of prescribe as to what would be the default based on which guarantee would be triggered? My answer is no. Default is something for the parties to define. Parties may, for example, say that anything which is more than 30 days past, 30 days DPD becomes a case of default. Parties, for instance, might say 90 DPD is a case of default. So default is for the parties to define at what threshold will it be taken to be a case of default. And in case of such default, what will I recover? As a lender, what will I recover? Will I recover just the EMI outstanding? Will I recover all the past EMIs which have been due? Will I recover just the last EMI which was due? Or will I recover the entire loan? For instance, I might say that on the loan reaching 90 DPD, the entire loan will be compensated by the guarantor. That's perfectly possible as a part of contractual stipulation. In the pre-8th June scenario, to my mind, I think most lenders would have actually done what? They would probably say that once the loan becomes 90 DPD, the entire loan gets shifted to you and you pay me the entire loan amount. So in my books, I would have recovered the entire loan by the guarantor making good the entire loan. This is still possible. It's still perfectly possible for a guarantor to compensate the lender for the entire loan amount. And therefore, the next part of the question is that let's say I've recovered the entire loan from the guarantor. Does that mean subsequently the recoveries will be done by the guarantor, or will the recoveries be done by the lender still? Now, let's once again understand that in most of these loan sourcing arrangements, the servicing is still done by the sourcing partner. Servicing is not done by the lender. However, the sourcing partner is doing servicing as a servicing agent. Therefore, as a servicing agent, he continues to service, and whatever recoveries happen subsequent to a full reimbursement of the loan amount by the guarantor, the subsequent recoveries will be passed on to the guarantor. Effectively, what it means is that what is the net loss, meaning minus recoveries, whatever is the net loss, that's exactly what is taken by the guarantor. That's one situation. Other situation is that I can simply recover the EMI outstanding and therefore let the loan continue as such. Let the next EMI fall due. However, I think the normal, I wouldn't be able to comment on the normal trend. That depends very much on the nature of the underlying exposure. But somebody who is reached, let's say 90 DPD for an unsecured consumer loan transaction, probably, I mean, he is almost like a write-off case. So it's still okay for the lender to recover the entire loan amount, versus it's also okay for the lender to recover just the EMI and wait for the next EMI to maybe fall due and therefore default and recover the next EMI once again. Question will be, how soon are you depleting the guarantee amount? The guarantee amount is still fixed. It's still a cap of 5%. So how soon are you depleting that? That's the only consideration, but it's contractually possible for the parties to work it out either way. Anita.
Right. Also, from the guidelines, it appears that the NPA treatment in the books of the lender will continue, even if the guarantee has been invoked. So if the lender writes off the loan, entire loan, and recovers the entire amount of loss from the guarantor, nets of the recovery from the guarantor to neutralize the debit on the PL, will the NPA treatment still continue?
The beautiful word we read in almost the same time as the DLG guidelines called technical write-off.
Write-off.
So nothing stops an NBFC or lender to do what is, and they were doing it all the while, or most of the NBFCs actually were doing a lot of write-offs. Write-offs were far more prevalent with NBFCs than with the banks. The RBI opened its mouth on technical write-offs in context of banks, but these so-called compromise settlement and technical write-off thing is applicable to NBFCs too. So nothing stops the NBFC from doing a technical write-off, meaning write it off in your books of accounts without obviating or without waiving the right of recovery. So right of recovery remains intact. However, I'm writing off the loan fully. So let's assume that the loan has reached 90 DPD. I trigger the guarantee and sweep the entire loan amount, outstanding loan amount, from the guarantor into my, let's say I dip into the guarantee and recover the money. So if I've recovered the entire money, the question is what will happen to this amount of recovery from the guarantor? Since I'm writing off the loan completely, there would be a debit to P&L account, either maybe by way of ECL or maybe by way of bad debt in this case. And I can then neutralize that write-off to P&L account by recovery from the guarantor, because my loss actually is the loan amount outstanding minus the amount recovered from the guarantor, which results into a zero balance. I've recovered the entire loan. So since I've done a technical write-off, the loan disappears from the books. There is no question of NPA treatment thereafter. And therefore, the NPA goes off. However, if I choose the other practice, which is to keep the loan outstanding, recover only the EMI, in that case, the loan continues to stay on books. And therefore, the NPA continues. The RBI says NPA treatment will remain intact. So unless I'm doing a technical write-off, NPA will remain outstanding. If the NPA remains outstanding, therefore I need to create a provision. I might have created an expected credit loss anyway. So ECL or the regulatory provision, whichever, the recovery from the guarantor can be netted off against the debit to P&L account, because that's something which I have already recovered. That would be my take on the accounting and NPA treatment, Anita.
Okay. And you mentioned that the recovery will be shared, recoveries from the borrower will be shared as per the contractual arrangement. So in case there are recoveries, can this recovery be used to restore the guarantee amount? What I mean to say is that the guarantee amount of 5% has been utilized against a loan, and now there has been recovery after the loan has been written off from the books. There is a recovery and I pay that amount or I share it with the guarantor. Can I again ask the guarantor to restore the guarantee amount to that extent?
My thinking would be that the question of restoring the guarantee by increasing the guarantee to the extent of recoveries, by the extent of recoveries, that would not be logical. Because the concept of a guarantor giving a 5% guarantee is that the guarantor takes a call. He makes a bet on the loan saying this loan or this pool of loans will have losses up to 5%. And if the losses are, let's say, less than 5%, because there was a subsequent recovery from it may either be the losses from the inception were less than 5%, or because of recoveries, the losses fell down to less than 5%. That excess should actually be the upside of the guarantor and not the upside of the lender. If the lender passes on the recovery, at the same time increments the extent of guarantee by the extent of recoveries, the lender is actually making or recovering that recovery from the guarantor once again by attributing further losses against the guarantor. Are you getting me? Because if let's say 5% becomes 6% because I recovered 1% from the outstanding loans, and I say now the guarantee is stepped up by 1%, what I passed on, I am getting it back in form of an increased guarantee cover. And that would mean the benefit of the recovery is actually not going to the guarantor. And therefore, in my perception, if the recoveries are passed on entirely, number one, recovery should be passed on. The question, while the RBI says contractually, you might provide for sharing of upside, sharing of recoveries. But sharing of recoveries is quite logical because The servicing is still being done by the LSP. If the LSP does not have the benefit of recoveries, why would the LSP at all, recover what is lost? Once the guarantee is dipped and his money is anyway sunk completely with no recovery at all, why would the LSP ever bother about recovery? That is not a healthy situation at all. And therefore, the recovery should be shared with the LSP. And if the recoveries are shared with the LSP, to my mind, the fixed extent of guarantee of 5% remains 5%. It can't be incremented by the recoveries passed on to him. Anita.
Will your view change in case the LSP is not the one who is doing the servicing, it is just the one who is doing the sourcing?
So once again, I say that normally the arrangement is the sourcing and servicing partner is the same, but even if it's a third-party servicer, assuming that's a third-party servicer, in the credit call was taken by the guarantor in the first place. If the guarantor's credit call turned out to be positive and therefore what was lost was later on recovered, the benefit of that should still go to the guarantor. The question of therefore neutralizing that recovery by increasing the extent of guarantee is the same as passing on the burden of further losses to the guarantor, which means the recovery becomes meaningless.
Okay, now next, coming to the disclosure part, the guidelines prescribe a disclosure requirement wherein they have mentioned that the LSP will be required to disclose on the website about the DLG arrangement, the total portfolio that it has originated, and the number of loans. So what extent will the disclosure be required? Is it disclosing the entire details about the DLG arrangement, or what exactly would be disclosed on the website?
Anita, I think you could probably be better off in answering this question, but my take is that it's number one, disclosure by the LSP. And number two, it's disclosure only to the extent of telling the borrowers that I'm also having a skin in the game, and I'm skin in the game to the extent of, let's say, 50 crores of originations, which I have from XYG company. So write the name of lenders, write the extent of portfolio value guaranteed, whether it's 5%, 3%, or whatever percent. I don't think the borrowers need to be told about which borrowers' loans have been guaranteed, whether loan taken by me has been guaranteed or not. That's also not something that the borrower ought to know. I don't think the borrower should know that. Therefore, all that the LSP discloses is the DLG arrangements. I have 5 outstanding arrangements with XYG, 5 different companies, where I have agreed to guarantee originations up to 50, 60, 100 crores or whatever. I think that, to my mind, and I don't know what purpose is it serving. Actually, frankly, I don't know what purpose of borrower information does it serve. I don't know. But what we've seen of late is wherever the RBI talks about some guidelines, it talks about some disclosure, some policy, some disclosure, something. So I think we are more and more disclosure focused. But I think that limited disclosure, I think, should serve the purpose, but you can add.
Just to add on, I do agree with what you have mentioned. And just to add on the LSP disclosure, since the website disclosure coming from the digital lending regulations itself, I have to disclose the name of the lender on whose behalf I am acting as an agent. I have to disclose my privacy policy, and there are several other requirements under the DL guidelines. This would be an additional requirement just to make sure that if I am taking this kind of a guarantee exposure on the borrowers, then it is being disclosed that yes, I'm having this in place, and it is not a hidden kind of a arrangement, and it is known even to the regulator or the borrowers that yes, there is some kind of an arrangement. But yeah, the details of those arrangements need not be disclosed. It is just the total number of portfolio which I'm originating or I'm assisting the lender with, providing my services, that needs to be disclosed along with the name of the lender. The last, I think, important aspect of this particular guidelines would be the capital treatment. What exactly will be the capital treatment for one, the lender, and second, the guarantor?
So let's, I think, first talk from lender's perspective. As far as the lender is concerned, the lender will be providing full capital at the required risk-weighted, capital adequacy rate. For example, if it's NBFC, it's 15%. 15% of the risk-weighted value of the portfolio, which again is mostly 100% risk-weighted. And therefore, the lender provides 15% capital on the portfolio. Now understand that the guarantee is actually pre-funded to the extent of 5%. The guarantee has to be either pre-funded or backed by bank guarantee. So here what we say, if it's pre-funded, I've got cash equal to 5%. And therefore, the value of the portfolio stands reduced by the extent of 5. I have, for example, 100 crores of portfolio value. I've got cash equal to 5% with me. And therefore, the portfolio at risk is now 100 minus 5, which is 95. So I'll therefore compute capital on 95% because to the extent I have cash, the risk is completely mitigated. 95 crores remains uncovered, 5% remains completely covered. The 5% is backed by cash and the risk weight for cash is anyway 0. If it's backed by bank guarantee, in that case, I'll provide the risk weight for a bank, which is typically 20%. So in that case, I'll provide a 20% risk weight on the guaranteed portion, 5%. The remaining 95, of course, becomes 100% risk weighted. And therefore, there is not any major capital relief for the lender because you're getting relief only on the 5% portion. As regards the guarantee provider, question of any capital treatment would be applicable only if the guarantor is a regulated entity. Guarantors who are non-regulated entities, they don't have any capital requirement. Therefore, in that case, the question does not remain. In case of a regulated entity, a very important point to understand that if it's a first loss default guarantee, FLDG as we say, and let's say I've guaranteed 5% of 100 crores, which means 5 crores is my guarantee exposure. The capital treatment is not 15% of 5 crores. It's the entire 5 crores itself. That is, I will need full capital for the entire guarantee amount. The principle underlying is that my 5 crores is actually exposure on a portfolio of 100 crores. Because that 5 crores is representing risk on a pool of 100 crores. And if I apply 15% of 100, the capital requirement is 15 crores, but my exposure is only 5 crores. Therefore, applying the lower of the two, 15 crores or 5, my capital requirement is only 5 crores. Entire 5 crores, not 15% of 5 crores, is the capital requirement for a regulated entity providing a first loss default guarantee. However, if we were to assume that this first loss is not first loss, but a second loss guarantee, and if the thickness of the first loss piece is sufficient to absorb expected losses of the portfolio, normally I would then apply what you call securitization rules. Securitization rules will say that if the second loss tranche, the risk weight for the guarantor is 100% risk weight on the guaranteed amount. That is, in that case, it becomes 15% of 5 crores and not 100% of 5 crores, as we said in the first case of first loss default guarantee. So the capital treatment for the guarantor becomes tricky because it's based on the securitization rules, which actually the latest securitization rules refer to ratings of the different tranches. But I'm assuming that most of these tranches will not be rated. And therefore, we apply the simple non-rated exposure rules. If first loss, the entire guarantee amount. Second loss, subject to first loss being thick enough, it would be risk-weighted capital requirement on the extent of guarantee. Anita.
So we have a couple of questions from our viewers. Right now, we have around 60 viewers who are.
And we must also say to all the viewers that if you have any questions, please be quick enough to post the questions on the chat. And so that, and your question, your participation is extremely important to us. And so that we can maybe get enriched with your questions and your comments, if any. And so Anita, let's go to the viewers' questions.
Yes. So the first one is DLG from a co-lending partner is covered under the circular. This I think you have discussed in detail.
In our view, not, and we're given the reason why not, because a co-lender cannot be said to be an LSP. The fact that the roles and responsibilities are segregated does not make the co-lender still a case of an LSP. It's only an LSP who is eligible to provide guarantee as per very clear language of the circular. So in our view, a co-lender providing a guarantee to another co-lender will be contrary to the principles of co-lending. In any case, not permitted as per the DLG guidelines.
Right. The second question that we have is what I understand from you on limit of 5% is that it is based on disbursement and not on outstanding portfolio balance in case of portfolio level guarantee. Is this correct understanding?
Yes, that's correct.
If there are multiple LSPs, can the guarantee be given by multiple LSPs up to 5%? The answer would be Yes, again.
The cumulative limit of 5%.
Right.
Though I actually don't see a possibility of multiple sourcing partners in there for multiple guarantors, but should there be multiple guarantors, it would be 5% for all of them put together.
Right. What is the difference between technical write-off and regular write-off? Is it that in case of technical write-off, we don't report to CIBIL as write-off?
CIBIL reporting, Anita, is your domain though, but the technical write-off, as we, I mean, sort of, we smiled when we use this word. It's a very hot word circulating over the last, 12 days or so. There have been a lot of non-technical discussions on technical write-offs, many having some kind of different flavors altogether. But today the RBI came with FAQs on technical write-off as well, and saying it's a very regular practice in banks to write off a loan if the bank thinks the loan is non-recoverable. A lot of NBFCs also have practice to write off a loan once it's 90 DPD or whatever DPD. So technical write-off is simply write off the loan in books of accounts. It ceases to be an NPA. My consistent feeling is that your books of account and CIBIL records are different things. Whether you have and how much you have as outstanding in your books of, are we saying the CIBIL records are reflecting your books of accounts? CIBIL records are recording the credit behavior of the borrower. Borrower
Right.
is still a defaulter. So where is the question of not reporting to CIBIL what you wrote off in your books of accounts? Because your books of accounts are the exposure or the recoverable amount of the exposure which you think you should be carrying as a carrying amount of in your books. But the fact that you wrote off doesn't mean the borrower's credit behavior has become good. That would be wrong reporting. The whole purpose of credit bureaus will get frustrated if people stop reporting to CIBIL what they wrote off in books of accounts. So to my mind, CIBIL reporting has nothing to do with your books. There's no question of a reconciliation between your books of account and CIBIL records. CIBIL records are borrower's credit history, not your books of accounts. That's a very, I think, fundamental misnotion that people quite often seem to be carrying, Anita, but CIBIL might be
No,
something that you would
I
probably not
definitely
understand.
agree with your view, because CIBIL report is actually about the borrower or customer behavior, and the technical write-off that I've done is as a part of my accounting treatment. It has nothing to do with it has no direct connection with the borrower behavior, and that is the reason the CIBIL reporting will continue as per the borrower's recovery. The next question is, in case of a co-lending arrangement, I think co-lending is a hot topic. And the question is that the front-facing co-lender also acts as the sourcing agent and is required to be compliant with the outsourcing regulation. Should be considered as LSP as well and can provide DLG.
I mean, I hate to repeat the point that we expressed. We would have been extremely happy, and we will, let me also say that we'll be very happy if the RBI takes a view which is against what we have advocated here, but I'll just state the reason for what we say and why we say so, and then leave it for the practitioners to frame their own views and maybe to plead with the RBI to maybe change our view, which we'll be very, very happy to change that. So our view is, once again, that segregation of roles and responsibilities between co-lenders is the very genesis of co-lending. You do this, I'll do this. That's exactly what co-lending is. Not both of us don't do same thing. We do different things, but for the same loan. For the same loan or lending business, we do different things, and that's how we segregate, allocate our roles and responsibilities. But I cannot say that I am an agent for the other co-lender. To the extent I am doing KYC, which whether the other lender is complying with or is adhering or resorting to or believing in, confiding in, that's the kind of outsourcing that we have done in respect of the co-lenders function. It's akin, it's not a case of outsourcing as such. Reference in the co-lending to outsourcing is merely to say that you can, to the extent that there is a KYC done with other co-lender, you can trust on him. But I cannot regard a co-lender to be acting as LS. So since, and that apart, I said the whole basis of someone guaranteeing a loan that is not taken, the segregation of a guarantor and the lender. The guarantor is not the one who is lender himself. The guarantor is an LSP who has guaranteed a loan which the lender has taken on the strength of an assurance given by the guarantor. Guarantor says, I am sourcing it for you. You Therefore, and then I'm creating an exposure of 5% on my own books, and which is how you take the loan on your books based on my guarantee. A co-lender is a lender himself. He takes a share in the loan. He's a lender. So a lender cannot be a loan sourcing partner. And therefore, to my mind, I will, like I said, this is the basis for our view.
And just to add to this point, I think under the CLM guidelines, co-lending guidelines also that are there, the reference to outsourcing in particular has been given to ensure that you don't outsource the credit sanction process. That needs to be ensured. So
Right.
that is why the reference has been given for outsourcing, and it is not that one of the co-lenders is acting as a outsourcing agent for the other.
So while saying that the co-lender cannot be a guarantor for the other co-lender, we are not meaning to say that the co-lenders cannot have differential sharing of risks and rewards. So effectively, one may be made senior, one may be made subordinated. It's always possible to have structured co-lending arrangements between the two co-lenders, but a guarantee is different. Guarantee meaning I will pay you. If the borrower doesn't pay you, then I'll pay you. Me paying for what the borrower is not paid. That doesn't seem like a partnership. Partnership meaning the two of us are together. Be it profits, be it losses, we are together. Profits or losses may be differential, but me paying you for your losses, that's what a guarantee typically means. That, to my mind, is not fitting into the concept of co-lending.
Right. What will be the accounting entry for FLDG invoked and paid by a regulated entity, which is an LSP?
For the guarantor
If it is a
who is
regulated
paying,
entity.
a regulated entity making payment of the guarantees, I think the regulated entity will have to write off a loss in its books, loss on account of guarantees. Typically, if it's following Ind AS, there'll also be a question of fair valuation of guarantees. I must add a minute just to give inputs on for those people who are following Ind AS. If you're following Ind AS, you don't have to wait for the guarantee to be triggered. To take a loss on the P&L account, you don't have to wait for the guarantee to be triggered. On the day on which you give a guarantee, you have to assess the fair value of the loss, the fair value of the guarantee. So if the guarantee itself is not giving you enough of compensation, because you are not saying that the servicing fees are a compensation for the guarantee, you're not charging guarantee fees. If you're not charging guarantee fees, then the guarantee has a fair value which has to be debited to P&L account on the very first day. So if you have debited the value of the guarantee as a loss on the very first day, which means you're carrying it as an asset on the balance sheet, the day when you pay it out, the asset will get the asset will get squared off, and therefore there'll be no hit going to P&L account. But assuming the amount paid by you as a guarantor is exceeding the losses that you might have taken to P&L account already, then the amount paid by the guarantor goes directly as a loss in the P&L of the lender.
Okay, I'll allow myself this benefit and ask you this question from my side.
Maybe I wasn't clear. So maybe I make it clear once again.
Yes.
So first issue, on the day of giving the guarantee, you would estimate the fair value of the guarantee already. And let's say I estimate that the guarantee will give me a hit of 3%. That's my estimation based on my fair value estimate. I would probably say the guarantee will give me a loss of 3. So I've debited 3% already to my P&L account, and I'm carrying it in my balance sheet as potential losses for a guarantee. If I suffered 3% only, there's no additional hit to P&L account because I already have hit my P&L account by 3%.
Right.
If, however, my actual payout goes to 5%, then I will now debit the remaining 2 to my P&L account. And therefore, I've taken a total hit of 5%. On the contrary, assume that, let's say, I estimated fair value of guarantee to be 0, or let's say I'm not covered by Ind AS, I'm covered by IGAP, and therefore I've not debited the fair value of guarantee at all. So I've not taken a P&L hit on the day of giving the guarantee. As and when the guarantee gets invoked and there's a payment made, or the fixed deposit or the pre-deposit gets depleted, the guarantor will continue to write off the extent of the asset and take a hit on his P&L account.
Okay, next, there's an interesting question. What about guarantees provided by anchors in a supply chain finance business? So, an anchor, will it be an LSP, and the guarantee that it is
My
provided?
first question would be, is it a case of digital lending? I wouldn't know. If you're talking about supply chain financing, I mean, actually, what is digital lending? Basically, originations which are predominantly done digitally. Supply chain financing, the entire supply chain financing business is based on physical supplies, physical sales happening. The sales invoices are factored or financed by the supply chain financier, whether it's purchases or onward sales. So it's based on supplies. I think the credit assessment of the beneficiary of the supply chain funding, be it suppliers or customers, is also done on a physical verification or a kind of credit evaluation process, which to my mind may not be digital. So I would need to probe into it to first ask, is it a case of digital lending at all? That's part one. If it's
And
a
in
case of
case it is, yeah, in case
supposing it is, let's say we come to a conclusion that that's a case of digital lending. The question is, who is the LSP there? Has somebody else sourced the loans for me? To my mind, not, because you are the supply chain financier, the vendor or the buyer. It could be sales or purchases financing, whichever way. The vendor or buyer is simply the contractual counterparty to a commercial transaction. It's not a loan sourcing partner. I wouldn't be able to say that the vendor or the purchaser becomes the LSP for you. So I don't think it's a case of LSP at all. And at the same time, I would say the vendor or the buyer is also not a servicing partner. So the whole concept of pool-based guarantee or the whole concept of synthetic securitization does not seem to be, I mean, though I said you said it's interesting question, so we just started thinking on that.
But
So
over here, so as an anchor, maybe the anchor is the one who is sourcing the
anchor is
borrowers for me, because
the one who's buying. Anchor might either be the vendor or might be the buyer. Quite
but
often,
then
let's say the
he's
anchor,
also the one who is sourcing the borrowers for me, because he is introducing the borrowers to the lender,
and therefore is giving a guarantee.
and therefore he's
Because
giving
see,
the guarantee.
no, I think if it's a case of purchases, then is obligating himself to pay the entire amount. The question of anchor giving a guarantee doesn't arise at all, because he's agreeable to pay the entire. If you talk about purchase financing, reverse factoring, then he's agreeable to pay the entire amount. So there, the question of any guarantee does not arise at all. If it's, let's say, sales financing, and therefore I'm saying it's my dealers, my customers who have been referred to you, and if these customers default, then I will pay. I'll pay what? I'll pay, let's say, a portion of, because normally in the case of sales financing, there is a concept of FLDG there as well. So if the anchor provides an FLDG, and if it's a case of a digitally originated transaction, I'm once again quite skeptical as to whether this will be a case of digital sourcing, because here the vendor is doing a physical supply, is not doing a digital supply, and therefore the origination itself is not based on predominant use of digital technology. So I would still think it's may not be a case of digital lending at all. And I mean, my impulsive thinking is that the whole concept of first loss default guarantee does not seem to be fitting here. And therefore, I don't need to cap it to, I mean, my thinking is that I don't need to cap it to 5%, because it's also not a case where excess of recoveries beyond a particular level are swept by the guarantee provider. The typical LSP arrangements are composition of two things. Number one, I'll provide a guarantee. Number two, I'll sweep the spreads beyond a particular level. You charge 24%, 26%, you give me only 16%, I'll take the receipt jewel. So the guarantee provider is also sweeping the excess spread. Here, the vendor, who is himself a commercial supplier of goods or services, while he might be guaranteeing for his own customers, but is not sweeping any of the excess spreads. So the concept of synthetic securitization being applicable here, that also to my mind is not applicable here. So I don't think the default loss guarantee framework fits here.
I think this will require a bit more
it requires further elaboration though, but my impulsive, like I said, with my first blush thinking is that we don't need to be bothered about any prohibition on DLG or a prohibition on synthetic securitization. It's neither synthetic securitization nor is it at all covered by this framework. So to my mind, it can still go peacefully without being disrupted either by the DLG guidelines of 8th June or by the bar on synthetic securitization. It's to my mind, it's neither, but well, of course, it requires further consideration.
Why should the limit be based on disbursement and not the outstanding amount?
Because the limit is based on outstanding amount, it would frustrate the very purpose. To give an example, if a loan of rupees 100 is guaranteed, hence the guarantee amount is 5. And when, what is the idea? Idea basically is up to 5, I'll be able to recover money from the guarantor. When the loan value drops to 80 and we say now the guarantee stands reduced to 4, I've actually reduced the guarantee cover. Idea essentially, and please understand, whoever is asking this question, please also try to understand that typically defaults are back heavy. If I got a loan pool, the defaults will normally be towards the trail of the reducing tail or trail of the loans. When 100 crores stand reduced to 20 crores, that's when you have maximum defaults, because there the defaults will be the 5 crores will start emerging as the loans come to a level of maturity. Good loans will continue to pay off. Bad loans will remain there in the pool. And the idea is of the guarantee of the first loss default guarantee is to protect the bad loans. So if the pool value continues to amortize or drop down, if the guarantee cover stands reduced, then the very purpose of the guarantee being there to take care of bad loans, that will get frustrated. So the whole concept of a structured default guarantee is up to 5% of the originations done under the cover of the guarantee. The guarantor remains liable. And because that guarantee typically gets triggered when the portfolio has reached some level of seasoning, by that time, a whole lot of good loans would have amortized already. But that's exactly when the guarantee is needed. So there's no question of the guarantee amount getting reduced as the POS continues to drop down.
What happens to FLDG arrangements prior to June 8 circular? Do we need to terminate the same immediately, or arrangements prior to the circular date can be carried on? So I think between September 2nd to June 8, these guidelines.
Could you actually have any similar arrangements?
I don't think so, because the guidelines.
This is actually a carve out. This is actually a relief.
Right.
So it wasn't that this is actually a new curve. It's actually a relief against a curve. What you are doing already, let's say you're doing, let's say, despite the curve, and you are doing it. And if what you are doing, let's say, falls or fits within this framework, please happily continue carrying it forth. But if you're doing it, let's say that what you're doing actually itself is beyond the regulatory permit prior to 8th June.
So the next question is, does performance incentive or collection incentive, increase in hurdle rate, etc., do they get covered under the implicit guarantee?
I think I will just be reiterating the point I made earlier, that differential servicing fees, the servicing fees which are linked with performance of the pool, do not amount to a guarantee. All I'm saying is that my servicing will be based on how good I am, like which is true for a whole lot of contractual arrangements. I get rewarded for my efficiency. I get bonuses when I do better. I get yield kicker when I do better. So the servicing fees are based on which are based on differential sharing or differential levels of servicing fees based on efficiency of the pool. That does not vitiate or violate the DLG guidelines at all. But I can have 5% DLG. I can also have, on top of that, I can have differential sharing of servicing fees. The servicing fee getting variable based on performance doesn't mean the servicer will start compensating. The moment the servicer starts compensating, that becomes a case of implicit guarantee. So that answers the question, Anita, you were asking me to give an example. Servicer says, I will pay you. I'm a servicer and I'll pay you by sacrifice. I will not receive servicing fees, one different thing. I will not be entitled to servicing fees, or I'll be entitled to less servicing fees if the pool doesn't perform or doesn't perform as per expectation. That's not a case of guarantee. That's a question of not getting what I would have otherwise received. So I'm losing my incentive. The servicing fees actually a sort of incentive to perform. I'm not getting my incentive. On the contrary, when I say I would compensate you for your defaults, that becomes a case of implicit guarantee.
Because the same person is asking, isn't the collection efficiency linked to performance risk and hence a type of implicit guarantee?
So I would reiterate. So once again, we can probably have a difference of view, and I would respect if there's a different view on that. But to my mind, a guarantee, explicit or implicit, is when a so-called guarantor, explicit or implicitly, says, I will pay you for what you don't receive. I will pay, meaning I'll pay from my own resources. I will not be entitled to get what I was entitled to get. That's not a case of guarantee, because that's only a linkage of my servicing fees with servicing performance. That is an employee who gets a bonus based on performance and loses his bonus when the performance is not good. Are we saying the employee is guaranteeing the employer? Right, Anita?
Okay, now the next question is the cash deposit. In case the FDLG is in the form of cash deposit, this 5%, and it is taken as an outside liability for the purpose of calculation of leverage ratio. Will it be taken as an outside liability for the purpose of calculation of leverage ratio for non-systematic?
NSI, non-systematically
Yes.
important companies, in case of liability.
I don't think this is a
I don't think so.
security deposit for me.
It's not a liability as it's not something. Well, if the guarantees don't get triggered, I'll be of course refunding it. But I think I wouldn't. I mean, while it's too small amount to be relevant for the 7 times leverage, because this would be 5% of the pool and not entire pool of yours is either guaranteed or for which you have a deposit. So it wouldn't be such a huge amount to actually matter for 7 times leverage computation. But if the question is still to be answered, I don't think I would take it. I wouldn't take it as a case of liability.
Will I be able to use this cash deposit because
Obviously, deposit. It's not money I'm holding in trust.
Right.
The difference between money held in trust and money held as a deposit. Deposit is intended to be used. I'll be able to deploy this money in my business. If had it been trust money, I cannot use it for my business. But it's a deposit, not a trust money.
But then saying that we can use
And neither is it deposit from RBI point of view.
It is surely not a deposit from RBI point of view. It is a security deposit. But saying that I can use or utilize these funds and still not treating it as a liability, will that?
So I'm saying it's a very technical question, and the query, I must appreciate the queries. I mean, ability to think, will it requires a tremendously, I mean, sharp mind to ask this question. So thanks to the queries to us, ask a very, very sharp question. But the issue is it comparable to a liability? Like I take money on a loan, I borrow money, I take ICDs. Is it comparable to that? The idea essentially, it's a liability to the extent the defaults don't get triggered, I need to refund it. So in that sense, it's a liability. But it's not a liability in the sense I've taken this money to fund my business. The essential idea of leverage is relative to my capital. How much stretching of outside funds am I doing? Right. In that sense of leverage, this is not fitting there. And therefore, I would say I would not want to take it as a case of leverage.
All right, outside liability.
See, because we're talking about a Shastrartha. So if you go to Shastra and look at the meaning of liability, well, it's classified as a liability. Accounting balance sheet will show as a liability. Somewhere on the liability side and probably as a part of liabilities only. So in that sense, one will say it's a liability, but it's not liability as a liability. I don't know if you can make it better.
If an RE acting as a co-lender cannot act, if an RE acting as a co-lender cannot act as an LSP and provide additional guarantee, what could be the intention to mention RE as a DLG provider? I think RE as a DLG provider, LSP could be a RE
as DLG provider doesn't necessarily refer to co-lender. RE can be a DLG provider for sure. There can be an RE who doesn't have a stake in the loan, refers the loan to other lender, and provides a 5% guarantee.
And I think one more reason, the intention to mention this could be recently we would see several REs are having these platforms. Earlier, there were two different entities. The fintech entity used to be a different who would have owned the platform or the website from where the loans were sourced. But now the NBFC itself was having the rights or the ownership of the platform. So that particular NBFC, in case, is providing the platform for sourcing loans of other NBFCs. In that case, it is acting as an LSP, but not as a co-lender.
I know the answer is very unpopular. To say that co-lenders cannot be guarantors makes it extremely unpopular. But like I said, I cannot help this view because as we think and as we read through the text, that's the impression that we're getting. But I must once again say to everyone, we will be very, very happy if we are proved incorrect. We'll be very happy.
So I think, okay, one more question just came up. So I'll take this as the last question for today. In revolving portfolio pool, we only have to take disbursements wherein the loan is still live. Do we also consider disbursements of the loans where DLG has been received, but loan is not written off?
So I think this is a very interesting question. To the extent the loan has been fully repaid, you're right, cumulative disbursements for the loans which are still live.
Right.
If the loan has been fully repaid, then there's no question of a fully repaid or reduced below 5%, assuming the guarantee is 5%. For loans which have been reduced below 5%, there's no question of a guarantee exceeding the outstanding principal itself. So cumulative disbursements to the extent of loans which are still live, however, not being higher than the extent of guarantee itself. So I think that's to sort of paraphrase it more perfectly. Thanks for asking this question. This question was very good question. So I think with this good question, Anita,
yes,
this has been a very good Shastrartha. And I think we are always so very obliged to all our viewers who enrich us with their questions and very important observations. We get a whole lot of inspiration from your participation, and will hopefully continue to get your cooperation and participation in future as well. We intend to continue more of this Shastrartha series with further interesting questions which continue to invoke more arguments. Anita, any final statement that you need to make?
No, I think we'll thank all our viewers for joining us today. Thank you, everyone.
Thank you very much. Thanks, everyone.